Welcome to the Deep Dive. Today we're exploring the world of investment deals specifically, the really interesting differences between going public versus staying private. And this conversation is actually part of the Journey series by ACE. They're a cross-border boutique investment bank really centered around this global network of investors and business owners. ACE has about 2 decades of experience, mainly in the MENA region, covering both IPOs and private placements, and they really emphasize what they call a people-to-people approach. So our mission today is to kind of unpack the why. Why do businesses choose one path? What are the hidden complexities? And importantly, what does it all mean for you, whether you're an investor, a business owner, or just curious?
That's right. Both routes, public and private, are distinct journeys. And understanding the basic reasons why a company might lean one way or the other is, well, fundamental.
Okay, so let's dive into that. Why go public? The big IPO splash. What's the draw there?
Well, a huge factor is access to, frankly, much larger pools of capital. You're tapping into public market investors, institutions, retail. It's a different scale altogether.
The different scale, yeah. And that scale helps with debt too, right? Using shares as collateral.
Exactly. Higher access to debt leverage is a big plus. Also, it helps ensure business continuation, sort of setting up a more permanent capital structure.
And visibility, being on that public stage.
Definitely. Higher visibility to stakeholders, a bigger brand presence, plus shareholders get that liquidity, the ease of trading shares. Mature companies often feel they sort of deserve a premium at that stage.
But there's a flip side, isn't there? What makes a private deal attractive?
It's almost the inverse, really. A key strategic reason is bringing in specific investors. Not just money, but partners who add real value, expertise, connections.
Right, strategic capital.
Yeah.
And avoiding the public market noise.
Precisely. Avoiding speculation on shares, dodging those really rigorous public company requirements, mandatory announcements, public financials, all that. It's less burdensome.
And I imagine cheaper in some ways.
Generally, yes. Lower cost, typically, because there are fewer mandatory parties. Plus, there's just much more room to orchestrate and negotiate. You can get creative with capital structures, mezzanine debt, preferred shares.
More tailored, less off the shelf.
Exactly. And you avoid the intense media spotlight. And sometimes, look, a business just isn't IPO ready. It's that simple.
So it's not like a fixed destination. Companies can move between these tracks.
Oh, absolutely. Many use private deals strategically to grow, aiming for an IPO later at a higher valuation. And some public companies even go private again, delisting.
So no single magic solution then. It really depends on the company's stage and goals.
Precisely. It's about finding the right fit for that specific journey.
Okay, let's talk about who's actually involved. The players. Public deals seem crowded.
They are. You've got owners, investors, public institutions, and retail. But the big player is the capital market regulator. They have a key central role overseeing everything.
Protecting the public interest, right?
Exactly. Which means a lot of mandatory regulator-approved parties. Lawyers, auditors, underwriters, banks, advisors. The list goes on. It demands a higher flow of information among more people.
And private deals, fewer people around the table.
Significantly fewer. Owners, investors, and advisors like legal, auditors, financial advisors. But these are usually preferred for advice, not strictly mandatory by regulation in the same way.
Less complex, procedurally.
Generally, yes. Though innovations like Nomu in Saudi Arabia are interesting, they try to ease the IPO path for smaller companies by relaxing some conditions.
What about the cost? The fees involved? Public deals sound expensive.
They usually are. Higher fees overall, fixed and variable, because of all those parties and regulatory hoops.
Yeah.
And crucially, considerable fees are often paid up front before you even know if the IPO will succeed.
Ouch. Success fees come later for advisors and underwriters, though.
Yes. Typically, a large chunk is tied to successful closure. Average fees can hit 6% or more the fund size, sometimes higher for smaller deals.
And private deals, lower fees.
Relatively lower, yeah. Fewer advisors, less regulation. And most fees are success-based, paid on closure.
But I think you mentioned something interesting. Advisor fees can sometimes be higher in private deals.
That's the counterpoint, yes. Because the deal design can be much more complex, and the advisor often brings a deeper, more specific investor network to the table. It's a premium for bespoke work and access.
Makes sense. Value for complexity. How about the actual process? Public IPOs seem very structured.
Very. Streamlined by the regulators, set subscription periods. You apply, meet information requirements, governance, audits, legal, memos get approved entities involved, do a roadshow, book building to set the price, then offer to retail. It's sequential.
And private. More fluid.
Much more driven by the dynamics between the investor and the owner. Interest can start from either side, Information flow follows investor needs, often an IRL information required list, then due diligence.
And deal makers can work for either side.
Yes, sell side for the owner, buy side for the investor, helping negotiate and manage information. But, importantly, both sides still need to meet relevant regulations, share sales, anti-monopoly, AML, etc.
And timelines can stretch out.
Definitely. Private deals can take a year, sometimes more, and they can be postponed, unlike an IPO with its fixed dates. It's much more flexible, but also less certain on timing.
This really underscores the strategic element, and it brings us back to ACE. Understanding these nuances seems core to what they do.
Absolutely. After working across both public and private deals, they specifically built their advisory around private deals. Their sweet spot is those deep people-to-people networks and tackling challenging deals in underfunded positions away from noise.
So focusing where maybe the broader market isn't looking.
Exactly. They talk about the unlimited satisfaction in solving complex deals, unlocking capital for businesses that aren't really visible otherwise. They enjoy the creative aspect of orchestrating and negotiating, especially cross-border deals, breaking down those geographical and cultural barriers.
And mentoring owners too, bridging knowledge gaps. It sounds very hands-on, very partnership-focused.
That's the essence of their people-to-people approach, yes.
Wow.
So pulling it all together, it's clear there's no single right answer, is there? No magic solution. It's all about aligning the path, public or private, with the company's specific stage, its goals, its tolerance for risk.
Strategic alignment, as you said, not just defaulting to one option.
Precisely.
We've covered a lot, the why, the who, the how, the costs. It shows just how different these investment journeys can be. So a final thought for you listening. What unseen opportunities might be hiding in those underfunded positions away from noise? And how could understanding these public versus private journeys better inform your own strategy, whether you're building a business or looking to invest? Something to think about.